Hey everyone, welcome back to Corporate Decoder. Today, BAC just filed its quarterly report, and I am seeing some key shifts in their business that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. While BAC is showing growth in some areas, their debt and market risks are something to keep a very close eye on. Let's dive straight into the numbers from their latest filing, which covers the period ending the 30th of June 2026. Looking at their income statement, net income for the 3 months ending the 30th of June 2026 was over $9 billion. That is a solid jump from about $7.2 billion in the same period last year. And for the first 6 months of 2026, net income reached nearly $17.7 billion, up from $14.5 billion in 2025. This increase is largely thanks to more non-interest income and net interest income, along with lower provisions for credit losses. However, their non-interest expenses did tick up. Their non-interest income itself saw a nice bump, reaching over $15.5 billion for the 3 months, and about $30 billion for the 6 months ending the 30th of June 2026. A big driver here was investment and brokerage services, which saw a nearly $875 million increase for the quarter, largely due to higher asset management fees reflecting better market valuations and positive client flows. Investment banking fees also jumped significantly, more than $710 million for the quarter, signaling strong activity in debt and equity markets. Market making and similar activities also performed well, increasing by over $1 billion for the quarter thanks to better trading revenue in equities. On the expense side, non-interest expense rose to over $18.6 billion for the 3 months and about $37.2 billion for the 6 months. The company pointed to higher revenue, related expenses, and continued investments in technology and marketing as reasons for this increase. Good news on the credit loss front. The provision for credit losses decreased compared to last year, coming in at about $1.4 billion for the quarter and $2.7 billion for the 6 months. This suggests a healthier credit portfolio. Now let's look at their balance sheet. Total assets grew to over $3.5 trillion. Deposits also increased slightly to over $2 trillion, but here is something interesting. Total shareholders' equity actually decreased a bit, mainly because of capital return to shareholders through stock buybacks and dividends, along with a dip in accumulated other comprehensive income. Diving into their business segments, consumer banking is showing solid growth. Net income for this segment increased by about $308 million for the quarter, hitting over $3.2 billion. This was driven by higher revenue and lower credit loss provisions. Average loans and leases grew, and importantly, average deposits also saw a healthy increase. Their global wealth and investment management segment, which includes Merrill Wealth Management and Bank of America Private Bank, also performed strongly. Net income here jumped by over $420 million for the quarter to about $1.4 billion. A significant factor was the strong growth in investment and brokerage services income, up almost 20%. Thanks to those higher asset management fees and increased transactional volume. Global banking also saw a nice boost, with net income up by about $348 million for the quarter to over $2 billion. This improvement was driven by higher revenue, particularly from investment banking fees, which surged by 50% for the quarter, and also lower provisions for credit losses, thanks to better asset quality in commercial real estate. The global markets segment really stood out with a massive net income increase of over $1.1 billion for the quarter, reaching $2.6 billion. This was primarily due to much higher sales and trading revenue, especially in equities, as well as stronger investment banking fees. Their total assets in this segment also grew significantly, reflecting increased financing activity. The all other category, which includes things not directly tied to the main segments, showed a net loss, but it actually decreased compared to last year. So, while not a profit center, it seems to be managing its losses effectively. Now, let's talk about how they're managing their capital. The board declared a quarterly common stock dividend of 32 cents per S-share, a 14% increase from the previous quarter. They also repurchased $6 billion of common stock in the last quarter alone, showing a commitment to returning value to shareholders. Their capital ratios, like the Common Equity Tier 1 capital ratio, remain strong and well above regulatory minimums. On the liquidity front, the company seems to be in a good spot. They maintain a substantial liquidity buffer, and their liquidity coverage ratio, or LCR, was 112% on average for the quarter. This indicates they have enough high-quality liquid assets to meet short-term obligations under stressed conditions. Their net stable funding ratio, which looks at longer-term stability, was also healthy at 117% on average. Turning to credit risk, the overall picture looks stable. Net charge-offs decreased compared to last year, and their allowance for credit losses, which is like a rainy day fund for potential bad loans, remains robust. However, they did mention that geopolitical tensions and inflation continue to be monitored for potential impacts on credit quality. Looking at consumer credit quality, residential mortgages, which make up the largest chunk of their consumer loan portfolio, showed some increase in non-performing loans. This was attributed to extended relief for borrowers impacted by the 2025 California wildfires. For their commercial portfolio, outstanding loans and leases grew, and overall credit quality improved, with reservable criticized exposure decreasing. They are closely watching industry trends, especially given the current geopolitical tensions and inflation. In terms of market risk, the company uses value at risk, or VAR, to measure potential losses in their trading portfolios. For the 3 months ending the 30th of June 2026, there was one day where trading revenue losses exceeded their total covered portfolio VAR, which is within the expected tolerance for their models. Their banking book activities show they are still asset sensitive to interest rate changes, meaning higher rates generally boost their net interest income. However, higher rates can negatively affect the fair value of their debt securities. Their debt securities portfolio is quite large, totaling over $871 billion at amortized cost. A significant portion of these are agency mortgage, backed securities totaling over $103 billion. They did note some unrealized losses in their available for-sale debt securities. But these are largely in securities with a zero credit loss assumption, meaning they are considered very low risk. The overall allowance for credit losses decreased slightly, driven by improvements in credit card and commercial real estate portfolios. The provision for credit losses also decreased, which is a positive sign. BAC continues to use variable interest entities, or VIEs, for securitization and other financial activities. Their maximum exposure to these entities is managed, and they reported no significant unexpected financial support provided during the period. Looking at shareholders' equity, the company continues to return capital through common stock repurchases and increased dividends, showing confidence in their financial position. When we look at their non-GAAP measures like return on average tangible common shareholders' equity, it shows a healthy 17%. This measure helps assess how efficiently they are using their tangible equity to generate profits. Overall, BAC showed strong financial performance in the second quarter of 2026. With increased net income and revenue across most segments, their capital and liquidity positions remain solid and credit quality is improving. However, they are managing significant market risks and geopolitical uncertainties. The increase in investment banking fees and trading revenue in global markets is a strong point. But the rise in non-interest expenses warrants attention. The debt levels, while managed, are substantial. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like this video. Comment your thoughts, subscribe, and join our Discord community linked in the description.